Welcome to a walkthrough of the warehouse building development and investment model. This Excel model template analyzes the profitability when constructing and renting a new commercial building such as a warehouse. We plan to rent multiple warehouse spaces to various tenants. This video explains how the financial analysis in this model works. Before we start, please hit the subscribe button to get notified when we release future videos, and also see the link in the description below where you can get the template for download. The example we are going to use will be a warehouse building which will be newly constructed. The building will have a gross floor area in our example of around 160,000 square foot, and about 90% of that area can be leased to tenants, meaning 9% will be a common area. A warehouse space will have a size of around 14 to 15,000 square foot. Now we need to analyze what we can do with these specs, what will be the total returns and profitability. To analyze all this, we're using this template, and you can see this Excel template has various worksheets. We have here an input sheet to enter the CapEx budget, an input sheet to enter the leasable spaces and the leasing assumptions, and then also another input sheet for all other assumptions. Then there are two worksheets which will do all the calculations. The timeline of this model is a monthly model and it goes 10 years out. So we calculate this on a monthly basis and then summarizing this on an annual basis. And we're basically calculating the whole thing. This will be a comprehensive forecast so that we really can understand everything about this project. We do run the calculation at the project level and then also at the investor level. We have here up to 5 investors we assume can participate in this project, and then also a profit sharing agreement will apply. We summarize our analysis in these two sheets. We have here a more detailed financial summary sheet. There is also a section on top which has the key figures, so if you like, or if you want to refer to quickly see the key figures, you can always open that and then close it. And as you can see, we have here all the tables which give you all the details about the forecast. The executive summary is a bit more condensed. Here we just want to visualize how this all looks like so that we have one page with the key information we need to understand the project. Another way is to present this project to third parties, and for this we have foreseen to build slides which we can then use, for instance, for a slideshow, going through the topics and explain each of these aspects of this project so that we can then also explain this to other parties if we would need to. There are several, up to 18 slides included in this template. The goal of this analysis is to understand the profitability of this project and then also have the tools at hand to run scenarios and try to, of course, to optimize the profitability. We start our analysis by first looking at the total investment costs. For this, first have to define by when our forecast starts. So we enter the start date or the closing date of the forecast. And then from this, we are plotting a monthly timeline covering up to 10 years. And what we're going to do is we're going to look at all the line items which we have to spend in order to build the warehouse building. And we'll first look at pre-construction expenses and the acquisition of the land. So enter the number of the land area times the price of the land. So we get the budget for the land costs. We add all other costs, and then we go into the details which we need of all the items we need to spend to construct the building, and then also any other soft costs. So what we want to do is to understand the total amount of our building construction budget. Then we also want to understand what's the relative cost per square foot so that we can compare the cost to all costs of similar buildings. These are just example figures. They are not meant to be accurate in every place. It's just to give an example. Then what we also need to do is we need to work through and define when will these costs occur. So we have here a timeline which covers all the months going forward, and then each line item, what we do is we allocate the percentages when these costs will be spent so that we know the CapEx plan. And then depending on the plan, we will have clarity when the expenditures are being spent and when the construction of the building will be completed. Now let's look at the rental income this building can generate. For the rental assumptions, we have here a separate input sheet which is dealing with all related to the rent roll. The starting point here is to find which are the spaces we can lease out and what's their size, and not only spaces but also parking, indoor and outdoor. So we enter all this, which then will total to the leasable area we have identified. We then enter the start of the leasing. If you are developing a new building from scratch and maybe you have already secured some first tenants, then you will know when these leases will start, how long they will last, and in case they will end, when will be the last month of the secured lease. If you have to, you also can enter here the lease incentives. How many months of free leases are you giving these tenants in order to motivate them to sign the lease? We also then entered the future leases. The question here is what's happening after the first lease expires. So how long is the idle period? What is the new duration of the next lease? And are there also lease incentives required? And this is then used to model the expected future leases again and again throughout the model. This sheet then has various tables. We keep track of the age of the lease. We calculate when exactly a new lease starts and ends. We have a plan which month will be free, which one will be a paid lease. We keep all track of this as a function of these tables. We then also have a table where we would have an option. If we don't want to forecast this with idle time and free leases and stuff, what we also could do is just ignore that and instead on the assumption sheet just enter a target occupancy rate, and if needed we could adjust this. At the moment I'm not using that way of forecasting, so I'll just set this to 100%. I'm using the assumptions from above with idle time and free leases to model my rent roll. We then keep track of which areas are rented by when. Parking will auto adjust depending on the occupancy of the leased spaces in this case to make it easier. And then we deal with the rental prices. And here again, every space might have different rental prices depending on the locations or how you negotiate with the tenants, if there has better access, if there are some features that justify higher or lower prices, so you can adjust the price per space. We do this first on a per square feet basis so that we can actually compare these spaces versus each other. And also, as you might notice here, we also have an option to simulate an expected price increase. In this case, we expect an annual increase of 3% for the rent roll. This is reflected here. If that's not the case, you can set this to 0 and then the rent would always stay the same. So you can model this here. We go back and then we have here the target rent roll and then the effective rent roll. The difference is that the effective rent roll does not include the value of the lease incentive. So this table here then tells you the expected rental income your property generates. And we can then also keep track of which areas or which spaces are the biggest contributor to the lease income. If we look here at the annual basis, we can see that and basically these assumptions we have to work through in order to forecast the resulting rental income. Rental income is not the same as profit a property generates. So what we want to do is we want to look at the forecasted net operating income. The way to do this is to look at the cost structure. What are the costs this building generates? So when we look at the cost assumptions we have to input, we have two types of costs. We have recoverable costs which then can be recovered from the tenants. Basically they are effectively paid by the tenant. And we have non-recoverable expenses which at the end will have to be paid by the landlord, by us. We then also have at the beginning some company formation costs, so we enter the budget, and then we can also specify in which forecast year these expenses are to be incurred. And then this gives us our forecast of the OPEX, of the operating expenses, and when net operating income. In case this building or this project also aims to charge a management fee for the party who manages the whole project, construction and then the leasing, etc., the model also foresees management fees. We anticipate either monthly fees or a development fee or then a fee at exit, and this is then forecasted and taken into account. So when we calculate the net operating income, we do this first before the fees and then also after deducting the management fees. What about financing? Here the question is how much debt financing we're going to use for this project. So what I'm going to do is I'm going to estimate the amount of debt financing by using the loan to value ratio. So I know I have 38.6 million to be spent for building this building, and in this example, and 65%, so I get the amount of debt. And if we look at the debt schedules, we have here different facilities of debt. I'm now only using one facility. And as you can see, we have here the drawdown. This is during the construction period. Then we have the accrued interest, which we don't have the money to pay interest during construction, so it just keeps accruing. And then at some point we start with the repayment of debt. All I have to do here is to go through these assumptions and basically define what will be the expenses, if interest being accrued or not, how the repayment schedule is working, if this is always a fixed payment or we only fix the amortization, or if it's a bullet payment. And then we also have to work through the timeline of doing that. Now in this case we have only one loan. It's maybe not a construction loan, it's just general debt financing in this example, but let's now take the example of a construction loan. In this case, a construction loan we will replace by a real mortgage at the end. So how is this going to work? What we're going to do is at the end to repay the construction loan. Now we have to define the repayment of this construction loan. So we're just going to repay everything in 1 month. Let's just add one period of grace, the repayment. So what I want to do is to repay this at the beginning of the coming year. So it's being repaid. And then what we're going to do is we're going to refinance this through a mortgage. In this case, I'm using a lower interest rate, and in this case, not accruing this, I'm going to pay this, and it will be a fixed service payment. As you can see, the drawdown schedule is in month 13. I'm using a grace period of, in this case, of 1 year, or we could say 6 months. So I have some time to find some tenants and get the leasing up and running. And then I'm repaying this over 30 years in this case. And so the repayment period starts and goes on throughout the forecast period. So this is then modeled here. And if we put this all together, we can see the whole debt schedule. So here we have the construction loan. Here we have the refinancing. It goes over to a mortgage. And then here we start to pay off the mortgage. And now if we look at the uses and sources of funds, we can see that the big part of the investment we finance via debt and then the rest in equity. This depends a bit on if it's residential, commercial, what's the relationship with the bank. Of course, you can enter your own assumptions here. The use of fund goes a bit beyond CapEx. We also analyze if there is accrued interest to be repaid, if there's working capital required, OpEx, management fees. So we do some corrections here, and this amount can therefore slightly vary. We also have here a plug for cash reserve. The way I'm using this is I want to get to a rounded figure for the equity financing amount, so I'm using a goal seek in this case to search what cash reserve I need in order that my equity financing amount is just a rounded figure I can easily work with. And then my financing structure is basically set and ready to go. If you look at the projections, you can then also see that the interest will pop up. So this is this line item here, and let's have a look here. So you can see the interest is increasing as we draw down more financial debt, and then at one point, once we start repaying the loan, the interest will go down. So we're all set, and now we have defined how we're going to finance this project. We want to review the yields this property will generate. We can look at different types of yields, starting with the gross yield. That's basically the annual rental income divided by the total investment made. If we also want to include the cost structure of the building, then we are looking at the net yield. We look at the net operating income divided by the total investment. This can happen before or after management fees. Or if we want to look more on a cash-on-cash basis, then we can either look at the unlevered or the levered cash yields. If it's levered, then we only look at the equity portion of the investment. And this is what we're going to do in our model. We're going to calculate the yield, starting here with the gross yield. And as you can see, this varies basically year by year. And in this case, it varies because we have some idle times and lease incentives which model in. And in this case, it will vary like that. If we look at the net yield is a bit lower. You can see this makes a few percentages, not much, we don't have a lot of costs, but still a few percentages would be lower. And then if you look at the unlevered and levered yields based on free cash flow forecasts, and we can see then the yield gets even a bit lower, because then we also take into account the capex and the financing structure. And you can then also see that the levered yields actually typically should be higher, because we have less investment to be done. We only look at the equity portion, but in this case it distorts a bit because we have these changes with the lease assumptions modeled in here. And just to compare, we then have yields summarized, and we can see how they develop over time. Once the building is constructed, we also need to think about the property valuation going forward. The way to do this, let's have a look at our model. The way to do this is to project the rent roll, which we have done, and then value the building based on a cap rate. And then we get the property's valuation. And we can basically do this or project this year by year going forward. We use the rental income, we capitalize by the gross cap rate, and we get to the property's valuation. We can then also check the implied net cap rate, simply dividing the property valuation by the net operating income instead of the rental income. We want to do both because in some cases the OPEX structure makes a bit of difference and we want to understand both here. And we can also see that in terms of the value per square foot, how this will develop, and when we compare to the initial purchase price, we can see there should be going forward that the building should lead to a higher valuation. Also first, it's fully rented, and then also if rent is going to increase over time, then this is reflected and will impact the building valuation. If we look at the individual years, you see here there's a bump. This bump is related to our months of idle, so this leads to less rental income. This is exceptional. If we can manage to get these tenants to renew without idle time, then this will look a bit different. You see then is a consistent increase in the property's valuation. This is what we actually should target for, that there is never any vacancies. And then we can see that it does make a difference. We can, over time, the building should become more valuable. If we then also look at how we're going to finance it, and we strictly look at it from an equity perspective, because we are financing 2/3 with debt financing, and then we start to pay off the debt. And then you can see now the upside, all benefits are equity, so we basically nearly double the value of the equity within these 10 years, it looks like, just reading this chart. And that's how we can use the framework within this template and simply value the building. Actually, at all times we know what the building is worth by using our framework incorporated in this model. This is how the property valuation works inside this template. At exit, maybe also to think about, there might be transaction costs. So whatever the property valuation is at exit, we then also have to deduct transaction costs we have to pay for brokers, legal, notaries, depending if these higher or lower, we just adjust the assumptions and then we know what will be the net proceeds. And also to mention, there might be a capital gain tax at exit. The capital gain tax, we also have assumptions for taxes. Apart from income tax, we can then also specify if there is a capital gain tax to be applied, or if not, we put this to 0. And that's how we value the property, and then also more accurately can forecast the value at exit for the property. Now we want to a conclusion, whether it's a good idea to invest into this warehouse development project or not. So we need to look at the overall profitability of this project. And the way to do that is to basically look at the profitability metrics. So once we look at the IRR and then we look at the cash on cash yield. And in this case, you see that the IRR, we can calculate it unlevered and levered. So levered is including debt financing, we're at 12%, and unlevered, we're at 7.6%. So ideally, this would be a bit higher than if we compare this versus the returns or the yields we can get if we buy another property. And in this case, we are using 65% leverage or debt financing, so it's not too aggressive. Maybe there's still ways to improve this, but at the moment, this is what it is. And IRR refers to a scenario of develop and then sell. So there's an exit involved, while cash on cash yield is a bit different. This basically reflects to a buy and hold scenario. If we look at the yields, you see the way it is calculated is we look at the annual yield, and we can see unlevered, it's already 6.2%, and levered even a bit higher next to our direction, going from 6 up to 9%. And you can see that this might even be attractive just to hold on to the investment, because if you can park your money at a 9% annual return on a levered basis, that's actually not bad. And this is all the metrics. It's important to look at several of these metrics, and the model calculates all what you need to do to fully understand the profitability of this project. Now, given that the funding amount is quite sizable, we might have to team up with several investors in order to provide the funding. And this then will also raise the question, how do we distribute or how do we share the profits among investors? So we need to look at the investment structure, who is going to invest. So we have different parties. We have one, the developer or the promoter, and then we have maybe some passive investors. And each of those is contributing some of its capital and gets a different stake into the project. But at the end of the day, there needs to be one who actually does the work, who oversees basically the construction, the leasing, the whole management of the property, and then also manages the whole exit. So one of these parties has a more active role than the others, and that's why we actually split the roles into a general partner and a limited partner. And now we need also to compensate the general partner for all his work is doing. And the way to do that, if you first look at that at the moment, everybody would get the same return, and everybody would also get the same multiple on its invested capital. So at the moment, the general partner invests and he gets proportionally the same return as the limited partner, which at the moment is a bit unfair, and it doesn't really provide strong enough incentive to also maximize the return. This is not that realistic for such a project. So what we need to do is we need to go and we need to define an incentive. And normally the way this works is we have to define a waterfall profit sharing model. So this means if the returns, the IRR of the limited partner is up to 8%, the general partner does not get any incentive because 8% is minimum what should be generated. But if the return exceeds 8 and goes up to 12, then we could start saying 15% of the excess profit goes to the general partner as an incentive and a fee. If the returns even go up to 15%, we start to share 20% of the profit. If it goes up to above 15%, it goes up to 25% of the profits are received by the limited partner. And now you can see first the profit sharing, 15, 20, 25%. So the better the return, the more the general partner benefits. And then you can also see the upside. Now the general partner gets quite a bit upside on his investment because also his work now is being rewarded. And if you look at the IRRs and the multiples, then you see that now the general partner will get a higher multiple and higher IRR than the limited partner. So this provides an incentive for developing this property and at the end also maximizing the returns of the limited partner. And this template offers you a framework to model all this by simply adjusting these parameters. If you don't want to use it, you could also disable the profit sharing. So you have the option to use it or not in this template. Now let's look at scenarios. One scenario is, are we going to develop and sell or develop and hold? Let's look at our business case, and basically what we want to do is IRR is for develop and sell, cash on cash is for develop and hold. And what we're going to do first is to study a bit how the IRR changes if you would, for instance, exit a bit earlier. What we're going to do is we change the exit years. Instead of exiting in year 10, we exit already in year 5. Let's look at our cash flow. So now what's happening is we are only invested up to 5 years, and then here we start to sell the building. And then let's look what happens to our IRR, and you see our IRR gets smaller. And this means, and now interestingly, if you go and increase the holding period, you can see actually the IRR was higher. So actually this would argue it actually is better to stay invested because then our IRR is going up in this case, strangely. Can be an indicator, that would be an argument why it's better to stay invested longer. And the other way to look at this is to look at the cash on cash yield. And here, and you can see that the cash on cash yield is clearly rising because the initial investment is unchanged, but every year we're getting the increase in rent. Remember, if we assume the 3% annual rental increase, that's why the rent goes up, and that's why also the yield goes up, basically on every metric. And then this means that the longer we stay invested, the better we get yield. Last year is impacted here through the exit because there's some management fees charged, just by the way, that's the reason. But if we would not exit, this would be also higher. So we look at this value here, and you see this is going up. So this would actually argue maybe it's not the best idea to park some money here. And it also comes down to what's your other alternative. Have you lined up another attractive project or not? So depending on that, you have to analyze your options and then see if it makes sense to stay invested or to sell it and do something else with your capital. Another scenario we want to look at is refinancing. Currently we are projecting these IRRs. This is based on the financing structure where we convert a construction loan into a mortgage, but in effect we have 65% LTV on the initial investment spent. Now the thing is that the property is forecasted to increase in value. So here we start with the construction costs, but once we start to lease up the building, and then over time due to inflation the value of the building will increase because the rent increases, and then if you capitalize it, the value of the building goes up. You see there's a difference piling up. And the question is, what would happen if we would do a refinancing in year 5 or year 7, because this would allow us to take some money out and this then should contribute to our return. So let's model a refinancing. So what we're going to do is the mortgage, we're going to stop it after 5 years, so 16 months. So what we want to do is to bring down the mortgage to 90% of its initial value during the course of 5 years. And then what we're going to do is we're going to refinance. In the month we have to repay the mortgage, we do a refinancing, and then we want to refinance at 65% of LTV, but this time not related to the construction value. We are switching to the property value. And you can see here the construction value means the capex was 40 million, but here now we can use a higher valuation of more than 49 million. So here we can get more money. So how does this look like? Let's look at the debt schedule. We look what's happening here. So this is the phase of the construction loan. We convert this into the mortgage, that's unchanged. We wait a bit with servicing, with repaying the loan, and then we start repayment over the 5 years. It's just very moderate. And now let's go into what happens at the year 5. So this has happened, in this case it's year 7, 2 years construction loan, 5 years the mortgage. So we're going to repay the mortgage, this is repaid, and then we take out the refinancing. And now refinancing, we have to the debt service will increase, so debt repayment will increase, and also interest will increase. But it means we can, if you look at the cash flow, let's have a look at the projections. So what's happening here is that we start to pay out dividends, and here it goes. Year 7 or 8, we can collect the proceed from the refinancing, we pay it out as dividends, and it positively impact our free cash flows. And due to this impact, we can see that yes, our returns actually will increase. So from this perspective, it will actually make sense, if you don't want to sell the building, to at least do a refinancing and take some money out to increase the return. What we then also want to understand is the impact when changing key assumptions such as rental prices, construction costs, or interest rates. How will our returns change? In our model, we can easily do that. So we look here at the return, and then now we start to vary some of our assumptions. So for instance, if I increase rental prices, you see returns go up. If I would say instead of plus 10, we'd go minus 10, then you can also see the returns get more compressed. So that's pretty big assumptions. Then for the capex, you see it reacts also, but it actually reacts to changes less. If I would save in capex budget, also I could push the returns. For interest rates, let's assume instead of 3.5 we pay 4.5%. So you see then the unlevered return, that's before interest, so that is unchanged, but these are going to change. If I would put 1.5, and you see I can drive the return down. So doing this gives me a better understanding on how the model works, and to understand a bit what are the risks and what are the upsides of the project. So that's why it makes a lot of sense to actually test your model for these scenarios. So I hope this video was useful to understand a bit better how to analyze investment in a real estate development project such as warehouse project, and then also how to do the analysis with tenants, with building value, with the debt financing. And also just to better explain how a template can help you to understand all financial aspects of your business case listed. If you like this video, please give it a thumbs up. Visit our website efinancialmodels.com, where you can find many more great financial model templates like this. Follow our channel, and I hope to see you on our next video. Thank you for watching.